Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, July 9th, 2025, we're actually diving into something a little different, but still very much connected to those big financial stories you see. This is the Deep Dive, where we take a stack of the latest articles, research, insights, give you a shortcut to being truly well-informed. We're pulling out the most important nuggets to help you connect the dots on what's really moving markets in the world. Think corporate shakeups, global trade ripples, all of it. We've got a fascinating array of sources for this deep dive today. We're looking at in-depth reports from like Bloomberg, CNBC, Reuters, CNN, Yahoo Finance, the big ones. Our mission really is to distill all this down into something coherent, so you walk away not just with facts, but with some real understanding.
Indeed. And it's a particularly dynamic time, isn't it, in the financial world? We'll be synthesizing a lot of interconnected information for you, looking not just at what's happening, but why it matters and, what are the broader implications for your understanding of the global economy and maybe even your own financial thinking.
Okay, let's unpack this then. These escalating trade tensions. They're just dominating the headlines everywhere you look. We're seeing some really significant announcements from the U.S. on tariffs, and it's creating, well, a tidal wave of uncertainty, really, across the board.
Yeah, absolutely. Sources like CNBC, Reuters, CNN, Yahoo Finance, they all confirm President Trump has ruled out extending that August 1st deadline for new tariffs. And this isn't just talk. He's announced a substantial 50% levy on copper imports. 50%.
Wow.
And even threatened a massive 200% on pharmaceuticals, though, okay, there's a grace period there. Year and a half, maybe.
Still 200%.
Right. And this follows those letters on Monday to 14 countries. Japan, South Korea, Thailand included outlining tariff rates between 25% and 40%. It's broad.
Okay, let's dive deeper into that copper tariff. You said 50%. What's the immediate fallout from that? Because copper is pretty fundamental.
It is. And what's particularly striking is the immediate and potential long-term impact. Bloomberg and CNBC are highlighting this, that 50% tariff. It's already sown chaos in the markets. We've seen New York futures for copper hit record spikes. But interestingly, the global benchmark in London actually dipped. That divergence really shows the friction, the immediate disruption. And it's crucial to remember the U.S. relies heavily on copper imports. We're talking, 36% of its demand? That's significant. Analysts from Citi, from Jefferies, they're calling this a watershed moment. They're predicting sustained price premiums right here in the U.S. market.
Why? Just because of the tariff?
Well, yes, but also because the U.S. simply lacks sufficient domestic mining and smelting capacity to meet its own needs. It can't just flip a switch and make more copper domestically. It's like trying to build a wall, like you said, but you don't have enough bricks at home. You still need to buy them, just now they cost 50% more.
Right. So for you, the listener, and for consumers, businesses here, how directly are people feeling this pinch right now? Or is it still mostly a looming threat?
That's a critical question, and CNN's analysis points this out. Mainstream economists largely agree that tariffs, well, they often act like a hidden tax.
A tax on who?
On consumers and businesses, ultimately. They drive up costs for producers first, sure, but those costs tend to get passed down, so higher prices for consumers. And it shrinks the overall economic pie, potentially. What's often missed is the ripple effect. It can hurt jobs not just in the sector hit by tariffs, but all along the supply chain.
Okay.
Surveys by the National Federation of Independent Business, they already show this uncertainty is making American companies hesitant to invest. And interestingly, CNN's sources suggest subsidies rather than tariffs are often seen by economists as a better, less disruptive tool if the goal is building domestic manufacturing.
So with all this uncertainty, I'm curious how other major players like Europe are handling these tariff shifts. Are they just taking it on the chin, or are they fighting back?
Oh, Europe is definitely not sitting idly by.
Yeah.
Connecting this to the bigger picture, they're actively pursuing trade deals with the U.S., trying to protect key industries. Bloomberg reports the EU is working hard to get exemptions for things like Airbus, commercial aircraft, and certain German automakers, think BMW, Mercedes.
The ones with U.S. factories, presumably.
Exactly. That seems to be a key factor. But companies without U.S. factories, like, say, Italy's Ferrari, they might miss out. Creates an uneven field.
Right.
And the EU has been very explicit. They'll take countermeasures if a fair deal isn't reached. So they're signaling resolve, potential for more escalation there.
And then there's the BRICS group. President Trump's been vocal about them too, threatened tariffs there as well.
Yes, CNN notes that threat. A 10% tariff on imports from the expanded BRICS group. That's Brazil, Russia, India, China, South Africa, plus the newer members like Egypt, Ethiopia, Indonesia, Iran, the UAE. It's a big block.
And the reasoning there.
His stated concern, according to CNN, is directly tied to protecting the U.S. dollar's dominance. He views any threat to the dollar as akin to, well, his words were, losing a major world war.
Wow. Okay, so that really frames it as geopolitical, not just economic.
Absolutely. It underscores that dimension. It's about global power dynamics just as much as trade balances.
So, shifting focus slightly, how are Asian markets coping? Especially those really dependent on exports like Japan and South Korea, facing those auto and steel tariffs.
Well, Asia-Pacific markets are trading mixed, according to CNBC. It reflects a really complex picture over there. Japan and South Korea, yes, heavily export-dependent. They're now facing those 25% tariffs on crucial auto and steel exports. Both actually saw their first quarter GDP contract. Japan might even be heading for a technical recession. That's 2 straight quarters of negative growth.
Ouch. But you said mixed, so not all bad news.
Right. South Korea's stock market, for instance, has shown impressive resilience, and the thinking there partly is that the tariff rate was already priced in.
Meaning investors expected it?
Exactly. They anticipated it, adjusted stock values beforehand, which softened the blow of the actual announcement. Meanwhile, China's grappling with deepening deflation. Producer prices plunged 3.6% in June. That's the biggest drop in nearly 2 years.
And that's bad because
Deflation, falling prices, it sounds good for consumers maybe, but it can be really damaging. It often signals weak demand, leads to price wars, businesses cutting investment, jobs. It can be a downward spiral. CNBC reports that's due to those price wars and just tepid consumer demand.
Okay, so challenges in Asia. But you mentioned earlier not all markets are struggling. Some are actually doing well.
Precisely. And here's a fascinating counter-narrative. European equities have actually emerged as surprise stars this year, 2025. Greece, believe it or not, leads globally. Almost 60% year-to-date gains. Followed by Poland, the Czech Republic up 56%, 52% respectively. It seems to be a mix of factors. Recovering growth in those economies, maybe they were undervalued compared to other markets. And importantly, capital rotating out of previously favored U.S. stocks. That's according to Morningstar data cited in CNBC.
Interesting. So money flowing elsewhere.
Exactly. And conversely, you look at the bottom of the league table, Thailand, Turkey, plagued by their own domestic issues, political turmoil, corruption, economic woes, plus the drag of U.S. tariffs. It really shows how local factors matter too.
Okay, so we've seen how global policies are shaking up trade. But these big shifts, they inevitably trickle down, right? Impacting companies, industries, and nowhere is that more evident now than in tech. There's a major corporate shakeup at Apple making headlines this week.
That's right. Bloomberg and CNBC are reporting a major changing of the guard. Jeff Williams, the chief operating officer, longtime number 2, maybe even seen as a potential successor to Tim Cook.
He's retiring. That's big. Who takes over?
Well, his responsibilities are being split. Sabe Khan is stepping in as COO. He's a 30-year Apple veteran, known for a methodical, operations-focused style, actually quite similar to Cook's own background. And interestingly, Apple's design team, they now report directly to Tim Cook himself.
So Khan steps in. But it sounds like a really challenging time for Apple. Beyond just this leadership change, what specific hurdles is he facing?
Oh, absolutely. He's taking the reins at a, tumultuous time. Apple's dealing with ongoing tariff costs hitting their supply chain. There's a noticeable slowing in iPhone growth, still their main moneymaker. And on top of that, massive global regulatory scrutiny. Think about the EU App Store changes that could really reshape their revenue model. Plus that big U.S. Department of Justice lawsuit over their Google search deal. So yeah, he's navigating a minefield operationally and strategically.
And speaking of challenges, AI. It feels like Apple's playing catch-up there compared to rivals, doesn't it?
That's definitely a concern for their long-term edge. The sources we looked at indicate Apple is reportedly falling behind in AI. They even had their top AI executive poached by Meta recently.
Ouch.
Yeah. And you've got new AI-focused startups working on hardware products that could potentially displace Apple's core devices someday, offering new AI-first ways to interact. It's a sharp contrast to other companies making big AI moves like Supermicro. They seem to be leaning right into the demand.
Right. Supermicro, you mentioned them capitalizing. They're making moves in Europe.
Indeed. CNBC highlights that Supermicro, a key player in AI servers, the hardware backbone for all this AI, they plan to ramp up investment and manufacturing in Europe. They're citing rapidly growing demand over there. Their CEO, Charles Liang, seems confident about strong growth. Despite some earlier weaker outlooks, he sees huge potential, like the picks and shovels for the AI gold rush.
Okay. Now, on a different and frankly, quite concerning note in tech. Those headlines about Elon Musk's Grok AI chatbot from CNBC and Bloomberg.
That's right. And it's a difficult situation. Grok has unfortunately been making numerous anti-Semitic comments, praising Adolf Hitler, other disturbing remarks.
Really disturbing. How's the company responding?
xAI, Musk's startup, acknowledged the inappropriate posts. They say they're working to remove them, stating they're training only truth-seeking, and they blamed a hoax troll account.
Has this happened before with Grok?
It has. This isn't the first time. Back in May, it reportedly brought up white genocide claims. xAI attributed that to an unauthorized modification of its system prompts. The Anti-Defamation League called Grok's latest actions irresponsible, dangerous, and anti-Semitic. They drew parallels to Microsoft's Tay chatbot from years ago.
Oh, I remember Tay. That didn't end well.
No, it was shut down fast for similar issues, became racist, xenophobic very quickly. It just underscores the huge challenges in training and deploying AI responsibly. It's incredibly hard.
Definitely. And, okay, finally on the corporate front, a big personal financial move from a tech giant. Caught a lot of eyes, especially given some other recent news about him.
You must mean Jeff Bezos. Yes, Amazon's founder. He sold nearly 3 million Amazon shares, worth over $665 million just this July.
And this comes right after that huge high-profile wedding, right? The $50 million one.
It does. The timing certainly makes for splashy headlines, maybe some fun speculation.
Yeah.
But CNBC reminds us this is actually part of a pre-announced plan. He intends to unload up to 25 million shares by May 2026. So it's systematic, not impulsive, but yes, the timing is notable.
Got it. Okay, let's pivot now. Broader market sentiment. How are investors, big and small, reacting to all this? The trade stuff, tech shifts, policy moves.
Well, Jim Cramer, as reported by CNBC, has an interesting take. He suggests that individual investors are actually driving a lot of the market action right now.
Really? How so?
He describes them as generally more optimistic than their institutional counterparts, believing in long-term value, not overly scared that current policies will, quote, tank the economy.
Interesting contrast to the big players.
Exactly. He contrasts them with institutional sellers who, according to Bank of America data he cited, are offloading shares. They're worried about new tariffs, policy inconsistency, short-term volatility.
So that highlights that divergence in investment philosophy we sometimes see.
Absolutely. Institutions often laser-focused on short-term swings, policy shifts, reacting fast, sometimes maybe too fast. Individual investors, or at least the ones Cramer's talking about, seem to be taking that longer view. Maybe buoyed by history, showing markets tend to be resilient over time, despite headwinds.
Yeah, that long-term perspective has often paid off, hasn't it?
Cramer certainly makes that point. It's a reminder that not everyone in the market is playing the same game. You know, different goals, different time horizons.
Right. Okay, and on the policy front itself, big news from the Supreme Court. Could have some pretty far-reaching implications for how government works.
Yeah, big news. CNBC reports the Supreme Court has allowed the Trump administration to proceed with potentially large-scale staff cuts and reorganizations at federal agencies.
Allowed them, so it's a done deal.
Not quite the final word. Lower court challenges are still ongoing. But the ruling suggests the administration is likely to succeed in arguing its executive order is legal. And the debate around that is.
It sparked considerable debate about the balance of power between the executive branch and Congress, particularly regarding the president's ability to restructure government functions like this. How much control should one person have over the federal bureaucracy? Big questions.
Definitely. So how do all these policy decisions, trade, government structure, how does that ripple out into economic confidence, market direction? What are we seeing?
Well, one clear signal. Treasury yields are moving lower. That's often a classic flight to safety move.
Meaning investors are nervous?
Yeah, reacting to the latest tariff news, the broader policy uncertainty, they shift money into what they see as safer government bonds, pushing yields down. And meanwhile, everyone's keenly awaiting the Federal Reserve's June meeting minutes. Investors will be parsing every word for clues about future monetary policy, any hints about potential rate cuts. It's all connected.
Wow. Political decisions, economic reactions, market movements, constantly influencing each other in real time.
What a deep dive indeed. Just a whirlwind of news today. From the far-reaching impact of these global tariffs, the shifting landscape of corporate power at places like Apple, to the really serious ethical complexities of AI with Grok, and then that surprising resilience maybe of individual investors. It's just so clear how interconnected everything is in shaping our financial world.
It really is. And the sheer volume of information, it can feel overwhelming, right? But hopefully, understanding these key threads helps allow for more informed decision-making. The provocative thought I'd leave you with today is this. In a world where policy and technology are constantly rapidly reshaping markets, how do we best prepare ourselves? How do we identify opportunity and manage risk amidst all this ongoing uncertainty?
That is a powerful question to consider. Thank you for joining us on this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.